Australia's growing household debt. Let's have a look. Hello everyone, Florian Heise here and welcome to another episode of Heise Says. I've got my stein of coffee and I thought we'd have a look at this article that was shared to me by one of my viewers. Why are we so worried about household debt? Now, the reason I want to talk about it is because if we look here from Trading Economics, one of my favorite websites at the moment, look at the ratio of household debt to GDP here in Australia. It's gone from the 80s at what, 40% to 120%. That is just crazy. And over that same time, look, here's another chart. This is home ownership. This is the max data we have from in the 80s, 70%, now down to 65%. What does that tell you? This is a concern. This is something we need to take into account and really think about with regards to a lot of what the government is telling us and what we're hearing in the media, particularly about the housing boom, the recovery, everything's great. I mean, household debt, that's insane. So guys, if you think these type of videos are important, please share the content with your friends and family on social media so we can talk about these things and get a bit of a understanding. So why are we so worried about household debt? The discussion of household debt and how it is meant to be the catalyst for a recession, house price crash, or some other melodramatic catastrophe is one-sided, dull, and invariably driven by purveyors of snake oil. Sure, the level of household debt in Australia is higher than it has ever been, and the average Australian household has more debt relative to their income than just about anyone else in the world, okay? So, yep. But so what? In isolation, this might be scary stuff, a worry. The reason why the Australian economy is at risk of an almighty collapse. In context, however, there is very little to be worried about. And given the remarkable level of assets and accumulated wealth that debt is benchmarked against. Okay, this will be interesting. In other words, the level of debt is a meaningless number unless it is benchmarked against the other side of the ledger, assets and wealth. Here are some of the basic facts about household debt and wealth in Australia at the moment. Household debt is 190% of household disposable income. Against that, the level of household wealth in the ownership of dwellings is approximately 500% of household disposable income, even allowing for the fall in house prices between the middle of 2017 and 2019. Okay, that's good, but let's just bring up this reference here. Our house sector significantly affected by foreign investment. And this is a chart from the Foreign Investment Review Board. You can see in the black, 2015, 16, over 90% of purchases for newly approved homes, foreign investment. So is that wealth, real wealth, at 500%? Is it in a productive asset? Remember, our economy is very primitive. We can have a look here. This is from the Observatory of Economic Complexity. You can see what Australia is exporting. And the complexity of our economy, we're one of the least complex. Oh, here we go. I've done the search, so I don't know why that's brought up, but that's fine. I'll wipe over here. So everything's going wrong at the moment, guys. So in addition to that, there are so-called household financial assets. These include things like superannuation balances, bank deposit, direct shareholdings, and the like. The value of these assets is approximately 430% of household disposable income. This means the level of gross household wealth is around 930% of income, which quite plainly swamps the 190% of household debt. Okay, let's look at these things that he's calling up here. What's he calling up? Superannuation balances. Okay, most of that's invested in property or shares. Cool. Direct shareholdings, well, how's that different from superannuation balances? It's also in shares. So these are both at risk of market downturns, particularly all the superannuations that have significant retail property holdings and are refurbishing a lot of their assets. That's also a risk. We saw that's a sector that employs 10% of the workforce here in Australia, but is heading down. And bank deposits, well, I mean, how safe are bank deposits, guys? In turn, this means net household wealth, which is the sum of all assets minus all liabilities, is approximately 750% of income. So Australian household balance sheet staggeringly healthy. In the chart below, the blue line is household debt, the green line are household financial assets, and the pink line is household wealth in dwelling ownership. The orange line is the net household wealth, is the pink line plus the green line minus the blue line. So there you go. There's our net wealth. Sounds good, but you have to think about where these are, where the exposure is, guys. Where is the exposure? Quite obviously, the balance sheet of Australia's households is staggeringly healthy. In fact, net wealth is only fractionally below the record high registered in 2017, having dipped from the record in the recent past as house prices fell. 20 years ago, when household debt was under 100% of household disposable income, net household wealth was just 500% of income. The worrywarts on household debt seemingly frame their miserable scaremongering and analysts on the fact that householders may be stressed if there is a sharp rise in interest rates, or if the value of financial assets cascades, or if there's some other disaster. Well, we've just had an invasion by Turkey and Syria. There is an ongoing trade conflict between China and the United States. There is tensions all over the world at the moment. There is negative interest rates everywhere. We've got our own Reserve Bank governor discussing the potential for quantitative easing. I mean, there's a lot of things to be worried about. Come on. And to be sure, these risks are there, but they're largely present regardless of the level of household debt. Yes, I know, but that makes more of a concern. So nothing to see here. Indeed, the last time there was a genuine problem with household debt and bank bad debts kicked higher was in the early 1990s recession, when household debt was approximately 75% of income. The level of household debt was plainly not that problem. Was not a problem? No. Household wealth in Australia is high and continues to trend higher, swamping the growth in household debt. There is a considerable buffer against a market downturn, like the recent dip in house prices or earlier bouts of weakness in the stock market, which had a negative impact on financial assets. That is not to say the household sector is immune from periodic bouts of weakness. Indeed, the current growth slump is due to large store of sluggishness in household consumption, which has been triggered by record low wages growth and weak labour demand. But don't forget to remember, the next time you hear a doom merchant highlighting, see, I'm highlighting, household debt as a problem for the economy, look at the level of assets and make up your own mind whether the problem is real or a gross exaggeration. So that is quite interesting, guys. What is your take on this in the comments? My concern is, I mean, the debt is offset to assets which are all highly dependent on external factors. And we're at a point now where our economy is so productive, it hasn't been invested. This debt has not been invested in productive assets. I'll bring up a quote here from Matt Berry, and this is one I've mentioned before. In 2016, 67% of Australia's GDP growth came from Sydney and Melbourne, and a quarter of that was from just the small area from Sydney CBD to Macquarie Park. So let's say this wealth that they're talking about is invested in maybe some apartments, and there might be potentially a risk of fire cladding or cracking or contaminated land or insufficient fire protection between sole occupancy units or illegal building work. Maybe, or balconies with insufficient railings. Just plucking ideas out of the air at random. What would that do to the wealth? Because a large portion of the GDP growth, we can see a quarter of it has gone into that. What would that do to the wealth? Why don't you let me know what you think in the comments, guys. Thank you for watching, and thank you for sharing this article with me. It's great to see alternative perspectives. Like, share and subscribe. And if you enjoy this content and want to help me produce more, please, I have a subscribe site and a Patreon on the links below. Every bit helps. I have a PayPal and even an Amazon link. You'd be surprised. If you're going to buy something, a tiny portion of it goes to support the channel and doesn't cost you a penny extra. So thank you all very much, and I'll talk to you next time. Take care.